What does minimizing shortfall have to do with the New York Yankees? Anyone? This research that we're going to show today has been on a 5 GMO fall conference game hitting streak. It's not as impressive as Joe DiMaggio, the Yankee Clippers 56 game, but we're getting there. So minimizing shortfall, deep risk versus shallow risk. Over the summertime, we polled over 200 financial advisors. What's the single biggest risk that your clients face? Volatility or shortfall? And interestingly, over 60% of them came back and they told us it was shortfall. That's really the heart of everything we do and what the presenters are going to talk about today. It's applying this research in a way that's tangible, something you can take away with you. Welcome to everyone in the room in Boston. It's delighted to be back in person. And welcome to all of our virtual friends. And a special hello to the friends and family of Nebo land. These are our early adopter advisory firms that have been working with us super closely. I'm Andy Finnegan. I'm one of the core members of the Nebo team. And I work really closely with today's 2 presenters. And over the past couple months, we've really been pounding the pavement hard, getting the Nebo needs-based allocation story out there. We've been at conferences in Florida, Texas, California, the first ever outdoor wealth festival. And the first week of September, we officially launched Nebo, the platform, if anyone has seen it on GMO. There's a fantastic, it's one of my favorite pictures. I sent it to my parents because I was proud. We were wearing tuxedos and we won a wealth award for industry disruptor. And today's speakers in terms of bios, our first presenter, Matt Kadnar. He's been at GMO, senior partner, senior member of asset allocation team for nearly 20 years. He's a very strategic thinker. He's helped build the forecasts. He's works very closely managing portfolios. In the last couple of years, really entrenched with just bringing Nebo just out there into the world, and also focused on our liquid alt strategy. We also have Dr. Martin Tarlie, who has a very impressive background. I won't go over his PhD credentials. Just know I think of him as asset allocation's own rocket scientist and coding ninja. He's written over 50,000 lines of code in the Nebo platform that you're going to be seeing today as a way that we're making this idea of minimizing shortfall tangible. And last year, if you were a repeat attendee, you might have heard the 50,000 lines of code. I have talked to Martin, and right now we're in the process of writing high impact code. So it's still a similar number, but every single line, every single letter or number is super important. And we want to engage with you. I have my computer as a little bit of a fire drill to make sure I can see all of our virtual friends, but please ask questions. We want a demo, we want to show you our story, and my over-under is at least 10 follow-up requests from this whole event. So please don't be shy. And with that, I think Martin's going first.
Thanks.
Oh yeah.
Thanks, Andy. So in terms of an agenda for the presentation today, there's really going to be 2 items. I'm going to just start by giving a high-level overview of what is shortfall, and then I'm going to hand off to Matt, who's going to illustrate some of the concepts that I'm going to be talking about in the context of a real-world case study. So let's start with the big idea. So what is the big idea? The big idea here is that risk is not volatility. So if risk is not volatility, then what is it? In our thinking, risk is not having the resources that you need when you need them. Now, what this framing does for us is allows us to build portfolios based on minimizing what we think of as shortfall risk. Shortfall is not having the financial resources that you need when you need them. But one of the other messages that I want to convey in the presentation, or at least in the first part of the presentation, and Matt is going to elaborate on this, is that our framework also allows for another framing. The other framing is it's not necessarily just not having what you need, it's also not having what you want. And we're going to explain how our framework also addresses that issue. What that does, it is expands the range of problems that our framework applies to. So if you're a high net worth asset owner or ultra high net worth, the same thinking applies. So in this context, what we mean by shallow risk is really volatility. Deep risk is that you don't have what you need or you don't have what you want. So let's just take a step back for a moment and ask the question, why is this idea so useful and why is it so powerful? And we think part of the reason that it's so powerful is because it's solving a big industry problem. If you think about the two components of the investment process, you have a financial planning component and you have an asset management component. But one of the problems that we're seeing is that the left hand is not talking to the right hand. There's a lot of really good work that's done on the planning side. There's a lot of really good work that's done on the asset management side, but those two are not coherently linked. Thinking about risk as not having what you need when you need it is really the ingredient that links financial planning and asset management. If you minimize shortfall risk, where risk is not having what you need when you need it, and you construct portfolios that minimize that risk, that's our needs-based allocation framework. And that's the key ingredient that links financial planning and asset management. And the heart of that is really portfolio construction. Portfolio construction is the crucial moment of action, and that's the heart of the link between financial planning and asset management. Okay, so how can we put our way of thinking about risk in the context of more conventional ways of thinking about the problem? So the conventional approach, in our view, is asking the wrong question. The conventional approach is asking how risk averse are you, and you have to specify a risk aversion parameter. But that's not the only problem with the conventional approach. The conventional approach also suffers in terms of how it actually specifies risk. So risk in the mean variance approach is the variance of returns. That not only accounts for low returns or negative returns, but it also accounts for upside risk. People have recognized this as a problem with mean variance. And this is addressed by a lot of work over many years to address the notion of shortfall or incorporate the notion of shortfall into a mean variance-like framework. The first example of this actually goes back to 1952. There was an author, Roy, who actually, at the same time that Markowitz came up with the efficient frontier, he also came up with an efficient frontier based on a safety-first approach. This is a shortfall-oriented approach. Over the years, there have been additional attempts to incorporate shortfall, but it's always within the context of a mean variance framework. So you still have to specify how averse you are to some measure of risk. It could be variance risk, but it could be some shortfall-oriented version of risk. But it still suffers from the same problem, is you have to specify a risk aversion parameter, which is very difficult to specify. But there's another problem with this framing of risk. And the other problem is it's focused on returns. If you go back to our specification of risk, not having what you need when you need it, that's really much more a wealth-oriented approach rather than a return-oriented approach. If the problem was a single-period problem, the distinction between returns and wealth wouldn't really matter very much. But once we bring horizon into the problem, remember, our definition of risk is not having what you need when you need it. So automatically, we've incorporated horizon into the problem. Once you bring horizon into the problem, the distinction between returns and wealth really matters. Let me illustrate that on the next slide. So on this slide, it's a three-dimensional graph. We have time coming out of the screen and wealth sort of going into the screen. And what we're trying to illustrate here is really a visual representation of what do you need and when do you need it. So if you start on the left-hand side at time zero, that thin line, the thin line represents that you have $1 with certainty. But now you're going to invest in assets where you don't know what the returns are going to be. So as wealth evolves over time, the range of wealth outcomes spreads out. By the time you get to 5 years in this example, the range of wealth is as specified in basically the red and the purple. Once you specify a target, a wealth target, in this case it's about $1.25, that's what you need. If your wealth is less than the target, that's shortfall. If your wealth is more than the target, that's surplus. So this is a visual representation of really what we mean by what do you need and when do you need it. And what we're trying to do, our definition of shortfall is falling short of a target. But what you'll notice here is that this wealth distribution is not a symmetric distribution. And this is where horizon really comes in. And on this chart, I'm illustrating a return distribution on the left-hand side, contrasting that with a wealth distribution on the right-hand side. So no matter your horizon, the return distribution will always be nicely shaped like a bell curve. It will spread out over time, but it'll always have a symmetric distribution. Wealth, on the other hand, because of the way it compounds, is very, very different. As your horizon increases, the right-hand tail of wealth becomes very long and very narrow. But if what you're interested in is minimizing shortfall risk, which is what we're interested in, the left-hand tail of the wealth distribution remains very stable. So when we're optimizing over shortfall, that gives us a very robust approach. Okay, so now I want to switch a little bit, and I want to focus not on the horizon elements of the problem, but how much pain you feel if you fall short. So illustrated in the chart here, the vertical red axis, think of that as that's my wealth target. Now the question is, how much pain do I feel if I fall short of that target? The default specification that we incorporate for that is if you fall 20% short of your target, you feel twice as much pain as if you fall 10% short of the target. Now, this is the assumption that allows us to incorporate both wants and needs into the same framework. So you might say, if I have a need, I might feel more pain than this. And if you can specify how much pain you would feel if you fall short of a need, we can actually incorporate that into our framework. There's nothing inherent to our framework that relies on this, I feel twice as much pain if I'm 20% short as if I only fall 10% short. By the same token, if you can specify how much pain you would feel if it's a want rather than a need, we can incorporate that as well. But what we don't want to do is we don't want to over-engineer the framework. This linear framework can accommodate both wants and needs, and Matt is going to illustrate that in a real-world example. So that's the first point on this chart. The second point is, how do we take a target and a horizon and convert it into something useful? So let me give you an example. Let's suppose we have $1 today, and in 5 years we've specified a wealth target of $1.25. Implicit in that is a target rate of return, 4.5%. That is what we call a TCR. Now, this is a really simple example. If we had intervening cash flows, we can account for those as well, and we could similarly calculate the internal rate of return. So this is the key number that unifies all of the kinds of problems that we want to solve. We turn what you have, what you need in the future, and all intervening cash flows into a target rate that you need your financial assets to compound at. So shortfall in this context now becomes relative to the target compounding rate, and it can accommodate both wants and also needs. So let's now return to the mean variance framework to put all of this back into context. So what we have here is a standard efficient frontier. I've illustrated 3 risk aversion coefficients. But imagine now that we have a problem where we've specified that we want to compound our wealth at 5% over inflation. If we have a 5-year horizon, it turns out that that works out to equivalent to a risk aversion coefficient of 4.3. But if you ask anybody off the street, nobody has any idea what their risk aversion coefficient is. But if they want to compound their wealth at 5% and they have a 5-year horizon, that's a much more natural specification of the problem. If you hold your target compounding rate fixed and you increase your horizon, you move up and to the right on the efficient frontier, exactly as you would expect. So what we've effectively done is we've effectively replaced the mean variance objective function with an objective function that accounts for the needs and circumstances of the asset owner. And those needs and circumstances are really parameterized or specified by an investment horizon and a target compounding rate. Now, in this really simple example, we just have one investment horizon, a 5-year horizon, a 15, and a 30. In the real world, you have a whole range of horizons. So if you're in retirement, you're 65 years old, and you think you're going to live until age 95, you have a 30-year horizon, and we accommodate those real-world complexities. But this is just a simple example to illustrate the main point. But this example also gives us a way to think about volatility. So going back to our, the shallow risk idea. We don't think of volatility as a risk. We think of it as a cost, and here's why. So imagine I have a target compounding rate. I want to compound my wealth at 5% over inflation. One question you might ask is, well, why don't I just pick the point on the efficient frontier that basically corresponds to compounding at that rate? And the vertical axis is an arithmetic return, so it's a little bit higher than the 5% compounded return. If your horizon is longer than 10 years, and you want to minimize shortfall risk relative to compounding at 5%, you should own a portfolio that has a higher expected return than the compounding rate. And how much higher depends on your investment horizon. So in this context, to minimize shortfall risk, you have to bear volatility. You have to sort of experience volatility. In that sense, volatility becomes a cost and not a risk. But the essential point is that using these ideas, we can frame not having what you need and when you need it in terms of investment horizon and a target compounding rate. And Matt now is going to illustrate these ideas with a real-world example.
Okay, so Nebo stands for needs-based optimization. So let's put Nebo to work here. So this is a case study from one of our Nebo advisors. I'm calling this particular individual Larry Bird. So Larry was a great Celtic in the 1980s. He was my favorite basketball player growing up. We're in Boston, so I thought talking about Larry Legend might be kind of a fun thing to do as we kind of go through this case study. Now, Larry Larry sold his business for $7 million. He, as part of that sale, he agreed to stay on with the new owner as a consultant. And so after about 6 months or so, lo and behold, Larry's just friggin' miserable. Turns out Larry is a much better boss than he is employee. So he goes to our advisor and he wants to retire. He wants to tell the new owner to go pound sand. He wants to take part of that $7 million, go out and buy a home in Jackson Hole, spend his winters skiing, spend his summers on the Snake River. You can tell that that's my editorial there. I mean, I find that particular retirement glorious. So does Larry. So the question is whether or not Larry can retire. And so our advisor took this problem and used Nebo to do the analysis on whether Larry could retire. And he showed Larry the analysis. And afterwards, Larry was so confident in the plan that Nebo created that he actually went back to the employer. He negotiated an additional $3.3 million as part of the severance and retired quite nicely. But he was able to do that, and this is almost a direct quote from the advisor, because of the confidence that Nebo provided, the confidence that he had in the plan that he could retire and retire comfortably. Now, it's also an example of how Nebo and the concept of risk is not having what you need when you need it, or not having what you want when you want it, how it can also apply to a high net worth or ultra high net worth investor. Oftentimes when we think about not having what you need when you need it, we think about trying to avoid having to eat, cat food or Spam or some other kind of gross, cheap food in retirement because you run out of money. But Nebo also applies to those folks who have a very little chance or essentially no chance of running out of money as well. Okay, so with that, we'll get into it. So we loaded Larry's basic information into Nebo. His current wealth is $7 million. He's age 45. The longevity that the advisor wanted is 100. So the assumption here is Larry's very fit, eats well, probably has some good genes too. So we're going to model out to age 100 here. And then Larry wants $7 million when he at age 100. So if he shuffles off this mortal coil, he wants to leave that $7 million to his heirs. And so that is in real terms, so maintaining that purchasing power, that $7 million over this entire period. So this is his goal. This is what he's trying to achieve. But we need some cash flows in order to make that happen. So Nebo allows you to do some simple cash flow analysis over here, but Nebo also allows you to import cash flows. So here you can import cash flows. So if you're using financial planning software, if you have a financial plan, you can import that directly into Nebo, or here you can also import a spreadsheet. So that's what our advisor did. So our advisor built out the cash flows from age 45 to 100. So all I'm going to do is cut and paste that here into Nebo. All right, this is one of the, oh, there we go. So doing a live demo is always kind of, you're holding your breath as you're making your way through this. So we have the cash flows pasted into Nebo. Okay, here we go. So I'm going to save these cash flows. And so you can see here, so we have the cash flows, we have the Larry's wants. We have this concept here of a post-retirement TCR, or target compounding rate, of 2.9%. The 2.9% is what Larry wants or needs from his financial assets in order to make his current wealth, his ending wealth, and his cash flows match up. So the TCR the TCR essentially expresses Larry's wants and needs into a number, and this number is actually the IRR that makes all of these cash flows work. But the TCR is actually much more than that. The TCR is the key parameter that defines the strategic plan. We can boil all these complicated cash flows down into a single number. Oftentimes we see advisors, when they're trying to profile a client, they'll focus on short-term risk aversion or short-term volatility. They'll focus on that as the risk. The TCR is actually the other side of the equation. The TCR is the return side, and we think that that's a more robust, a better starting point than focusing on short-term risk aversion, short-term volatility. That's not to say that short-term risk aversion isn't important. It certainly is, but it needs to be balanced against the long-term needs of the client, and that's what Nebo is designed to do, to help with that balance. So once we have our cash flows, we can, in our financial plan, we can go about assessing the viability of that plan. And so for that, we're going to use the concept of a glide path. So now part of, whenever you have a glide path, obviously you're going to need some capital market assumptions. And so here the capital market assumptions that we're going to use are the GMO views. So a return of 4.9 real for stocks, bonds 60 basis points, short-term bonds 30 basis points real. And this number, this TCR, is actually in real terms as well. We always want to make sure we're looking out for the long-term purchasing power of the asset. Now Nebo is flexible from an open architecture perspective. We're at a GMO conference. Martin and I work for the asset allocation team, so we're going to eat our own cooking here, and we're going to use GMO returns. But Nebo is flexible in terms of the returns that it can use. It can use your own firm views, if you like, and that firm views can incorporate third-party views from other asset managers. You can use equilibrium views, and you can even use custom views. You can kind of change each individual number if you're iterating on a financial plan. So once we have the capital market assumptions, then we're going to generate a glide path. So really, this is really kind of the secret sauce within Nebo. So this is a glide path, and what the glide path is doing is running a 55-year optimization, 54-year optimization, 53, all the way through. And it is minimizing shortfall relative to Larry's wants, relative to Larry's target compounding rate. It's picking the asset classes that minimize shortfall across the entire investment horizon for his retirement. You can see we start at about 80% in equities. We wind down at about 15% over time. So Nebo, as Martin talked about, Nebo recognizes that we have a very long investment horizon for this client. He's retired, but he's got a 55-year investment horizon. And so Nebo recognizes that and owns more equities early in the retirement phase in order to minimize the risk that Larry doesn't have what he wants later in the retirement phase. Now, once we have our glide path, we can go about analyzing the viability of our plan and the glide path through our next generation Monte Carlo simulations. So here we divide the output into the long term and the short term. So the long term has the probability of success, 97%, the wealth at different levels of the distribution. I'm going to focus your attention to these two charts down here at the bottom. So on the right, we have the success probability going all the way, moving all the way through retirement. So you can see we have about 100% probability of success till age 60, and then that declines very modestly to about 97% over the retirement horizon. So 97% probability of success, very strong. Over here on the left, this black line represents how wealth will evolve if you generate your returns at the target compounding rate and you take into account the cash flows that we were just working with. The blue lines represent the top and bottom quartile of the distribution for the Monte Carlo simulations, and the circle in the middle represents the median level of the distribution. So you can see the circle stays well above the necessary wealth level all throughout retirement. So again, Nebo recognizing that Larry has a long investment horizon. So in order to minimize the risk in his out years that he doesn't have the resources that he wants, Nebo owns a portfolio with a higher compounding rate than 3% in order to minimize that long-term shortfall risk. Now, in addition to this Monte Carlo analysis, we can also do some withdrawal simulations. So this was actually an idea from one of our Nebo advisors. Nebo is basically gone through a 3-year process of user-led development where almost all of the features that you'll see are an idea from a particular advisor. So here we're going to do some scenario analysis with respect to withdrawals. We have the initial withdrawal rate, the withdrawal in current dollars, the average withdrawal rate in current dollars, median wealth, and the probability of success. And so you can see that going down all the way almost to $200,000 in terms of the average withdrawal, Larry still has more than an 80% probability of success. And that was a pretty important point for him in this analysis. This gave him some confidence that this number, 200,000, was actually about 25% more than what he was planning. So he recognized that he had some additional wiggle room in terms of the retirement. And that was a key point of his confidence that allowed him to go in and negotiate that extra pay package. But I also want to draw your attention to the 4% withdrawal rate, which has a 20% probability of success. Oftentimes in retirement literature, they talk about the rule of 4, the rule of the 4% withdrawal rate. Well, that normally is assuming a 30-year investment horizon, ages 65 to 95. Here, because Larry has a 55-year investment horizon, the cash flows associated with that are more sensitive because of the long-term horizon. So for Larry, it's less about a rule of 4% and closer to a roll of 3% as we think about the withdrawal rates. So ultimately, can Larry retire? Well, it seems like he can retire pretty comfortably. You know, this was the analysis that the advisor went through in order to convince Larry that he could retire and gave him the confidence to go out and negotiate that extra package. Now, I do think Larry was somewhat unique. You know, all of what we were talking about here has been related to the long-term risks provided in the plan. And we know that clients care an awful lot about short-term. So we do have short-term metrics here, drawdown in the 5th percentile, drawdown in the 1st percentile, and the 1-year volatility. But what Nebo allows advisors to do is balance these short-term risks versus the longer-term risks. What Nebo allows the advisor to do is have a conversation with a client whose short-term, his focus on short-term risk aversion is actually increasing the risk that they don't have the resources they need in the long run. And so it allows the advisor to have a more meaningful conversation about how to change the portfolio for the client's best long-term plans, or alternatively, to make a more informed decision about how their short-term risk aversion is really jeopardizing their long-term goals. This is really where the art of being a financial advisor meets the science of Nebo and the science and math of Nebo, helping the advisor to achieve that balance. Well, I am happy to say that Larry did graduate from being a client, from a prospect to a client. And that also opens up an additional thought. All of this analysis has been based on goals-based financial planning. But now that Larry's confident in the plan and he's comfortable with the plan, that allows the advisor to pivot from this goals-based approach and focus on a more possibilities-based approach. What happens if Larry decides to raise the bar a bit, to increase that TCR from 3 to 4%? What does that do for his possibilities in retirement? So Nebo can handle that as well. So here we're going to go to the glide path tab. This is the glide path that we just looked at with a 3% target compounding rate. This is the glide path down here with a 4% target compounding rate. You can see the 4% glide path owns more equities. We have the same analysis over here to the left, so the same statistics, which will allow the advisor and Larry to analyze the trade-offs involved in moving from a 3% target compounding rate to 4%. But it also allows the advisor, again, to present some meaningful choices as to how Larry might think differently about retirement and the possibilities within retirement if he does decide to raise the bar a bit and increase that target compounding rate. So I did want to give a quick word here about Monte Carlo simulations. So I referred to the Monte Carlo simulations that we just saw as next generation Monte Carlos. As we look at most financial planning software, most out-of-the-box Monte Carlos, we see two pretty significant deficiencies. First off, they generally don't account for current valuations and the mean reversion of assets over time. And secondly, they use flawed assumptions related to how they model the volatility of stocks and bonds over time. They focus on the random walk theory in modeling that volatility. That is, in our view, antiquated, it's flawed, and it compromises any results related to the Monte Carlo simulations or any optimization that is using the random walk in its assessment of volatility. So what do I mean by that? So here we have investment horizon in years, 1, 5, 10, 15 years, and then we have volatility on the y-axis. Here's the volatility profile of bonds, and this is bonds in real terms if you assume a random walk. It's basically volatility, 1-year volatility, 10 and 15-year volatility is just not annualized, so it's a cumulative volatility calculation. Now, when we go back and actually look at the performance of real bonds, the impact is what we see are bonds are actually significantly more volatile than what the random walk assumes. As we look at stocks, here's the term structure volatility for stocks. And what we see in history is that stocks are significantly less risky than what the random walk would assume. What's going on here? So for stocks, in one period, if you have a loss, all other things being equal, the next period, your expected return for that next period is going to increase. We've seen this time and time again through history, all the way back to the Chester A. Arthur administration, but that is something that the random walk theory completely ignores. On the bond side, if you have unanticipated inflation, kind of like we've seen this year, that will produce a permanent impairment of capital to your bonds. And again, the random walk theory completely ignores it. And so the result is if you don't pay attention to this, you result in bond-heavy portfolios. Bonds seem less risky than they really are. And then you underweight stocks because they appear to be more risky than they really are, ultimately compromising and skewing your results. Nebo, of course, corrects for this. Now, back to Nebo. We have a plan. We feel pretty confident about that plan. Larry's now a client, so we need to go and build a portfolio for today. Nebo, at its heart, is an asset management platform. It's embodying a lot of the knowledge that we've gained in asset allocation over the past 30 years, all ultimately to build portfolios. So in the portfolio tab here, we have the information for needs and circumstances from the needs tab. We have our constraints that we want, if we want to put into the portfolio here in the middle. Then over here to the left, we have our investment schema for our fictional Acme advisors, stocks, long-term, short-term bonds, and liquid alts. These single asset class building blocks are customizable to each firm. Anything that doesn't fit neatly into those single asset class building blocks, we call them custom alts. So here, Acme Global Credit, Acme Real Asset. The architecture of the system is incredibly flexible. We haven't met an investment schema that we haven't been able to map into this framework. That involves illiquid assets, private equity, private credit, annuities, short-term cash buffers that we want into the portfolio. Nebo's very flexible. What Nebo allows the advisor to do is import their investment philosophy, their investment process, their investment philosophy, their investment persona, and we map that into the single asset class building blocks. And that allows Nebo to then run its shortfall simulations, its next generation Monte Carlo analysis on top of that. The structure is incredibly flexible. So here, I built the portfolio already. This is the glide path that we just saw on the needs tab. To the left, we have the allocations for Larry and the Acme advisors. 63% in stocks, 13% long-term bonds, short-term bonds at 9%, and then 15% in the global credit. We have factors, the equity factors, that again, that is customizable to each firm. We have factors within the long-term bonds, short-term bonds tabs as well. And then ultimately to the right here, implementation. So again, this is open architecture. I did skip over one important point. Once we have the single asset class building blocks, again, we need capital market assumptions. Just as with the glide path, this is an open architecture framework. Here, more home cooking. I'm using the GMO views, but you can also use the firm views that you create, equilibrium views. Nebo can handle all of that architecture. And in terms of the implementation, what we see advisors use, there's certainly obviously mutual funds, target date funds, but Nebo is also flexible enough to accommodate individual securities as well. One other thing when we talk about Nebo. Nebo's not a black box. Nebo it's not artificial intelligence. It's enhanced human intelligence. We want to make people better investors. We want to align the portfolio with a plan in a way that they can understand the key inputs in terms of the key inputs that are driving the return in a portfolio. What do you have to believe in order to have a 15% allocation to credit in terms of returns, volatilities, or correlations? It allows you to test your intuition, sometimes confirming that intuition, sometimes actually creating a new intuition as you figure out what you have to believe in order to own the portfolio. What we hear from advisors, it gives advisors a significant degree of confidence that their investment views are being reflected systematically in building portfolios to clients. So I'm going to wrap up here. Time is getting a little short. What advisors tell us about Nebo, and Martin, Andy, and I have had more than 100 conversations with advisors over the past 6 months, is that Nebo helps them build a better business. It helps them do a better job for the clients for less money. It helps them align the portfolio with the plan in a systematic way. And that inspires confidence with the advisors. Confidence that the advisors have the clients in the right portfolio. And as we kind of sit back and think about all of our conversations with Nebo users, one of the things that we do here quite a bit is an increased level of confidence. And if you define risk as not having what you need when you need it, or not having what you want when you want it, that is unique. That is personal to each client. And that's personalization for real economic reasons, not crappy marketing reasons. I was this close from letting it fly. But this is real personalization for economic reasons. And then lastly, to help you grow your business. When one of our first demos with an advisor, he sat and he looked at what Nebo produced and he said, wow, Nebo just did in a couple minutes what I've been working on for the past 3 hours. Another advisor told us that he doesn't believe he's going to have to go out and hire 2 additional financial planners in order to meet the growth the growth that he wants, the growth prospects that he has. And it's providing, increasing the efficiency, building better, building more robust portfolio, but allowing advisors to have more controlled growth. So as they grow, they can also increase their service level. All in an open architecture framework. All right, so we're getting kind of close here. I'm almost out of breath. Martin, Andy, and I will talk your face off on this stuff. If you have more questions, please reach out to us. Just Google Nebo GMO. We have a website with case studies and demos and all sorts of good stuff. But we do actually have a couple minutes for questions, if anybody has any.
How sensitive is it to your capital markets?
I was wondering how sensitive it is to your capital market assumptions.
Is my mic on? Yes. So I'm going to answer that two ways. The first way is you can test the sensitivity to our capital market assumptions, but you can also test the sensitivity to your capital market assumptions. So that's really the essence of Nebo is, as Matt said, it's not designed to be a black box. It's designed to help you answer exactly that question. How sensitive is the portfolio that I'm going to own for my client to my capital market assumptions? Which are the key capital market assumptions that are driving the portfolio today? What we find is that the answers to those questions actually change over time. So as market conditions change, the answer to that question changes. But Nebo's designed to help you get more insight into those questions. And that's the kind of confidence that we see the advisors having because of Nebo. It's helping them understand what is driving the portfolio. But it's open architecture, so it's not so much our capital market assumptions as any capital market assumptions.
So you mentioned the user-led development. What have you found to be some common errors that people make along the way? For example, underestimating taxes or cash flows too high, too low?
I would answer it this way. I don't think we're in a position to say these are the errors that they're making. I think the pattern that we're seeing is that the way Nebo layers the questions that the advisor asks is it provides sort of a very structured layering process in terms of them understanding how are my assumptions about taxes coming into the process? Where in this sort of structured process are taxes coming in? Where in the process are my assumptions about single security alpha selection coming in? And so we're really focused on helping advisors understand better what is driving the portfolios and the layering process. So Matt didn't actually show this for lack of time, but the way the investment schema gets mapped is there are single asset class building blocks. Then within each building block, there are factors. Those could be regions, it could be value, it could be quality, and then there's implementation. And so it sort of structures a thought process that allows you to ask questions at each layer, generating a deeper level of understanding about what are the key questions in each layer. And that's why this common theme that we see across a variety of use cases. So we have a wide variety of use cases now, from small firms to large firms. The common theme is I have a lot more confidence in my process because I'm using Nebo, and it's because of the way it structures your thought process.
One of this isn't necessarily a mistake that we see, but it is a common refrain in that advisors know that it's very hard to systematically link the portfolio with the plan. And there are not many tools out there that they're comfortable using in doing that. And then they also know that a lot of the Monte Carlo simulations really aren't what they need them to be. And so that really casts, again, a fair amount of doubt in terms of the plans that they create. And so, I don't know, those aren't mistakes per se, but there are tools that are lacking in order to kind of address those issues. And that's frankly why we built Nebo.
So you're in a space that, very nice work, thank you for sharing. You're in a space that conventionally is thought of as being somewhat crowded, but that also, as you've pointed out, contains a lot of not fully fleshed out thinking. So I'm interested to know, what is your objective function for Nebo?
Do right by the, well, it's really twofold. So actually Jeremy's in the audience, and one of the mantras at GMO is you do right by the client and everything takes care of itself. So we want to do right by the asset owner, and we want to do right by the advisor that's advising the asset owner. And if we do that, we'll be just fine.
This red thing means we're over, right? Okay. Listen, we're here to talk. We're here all afternoon. If you have any other questions, thank you very much for attending. I hope you enjoy the rest of the conference. It's going to be great.